Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will discuss machine learning. Machine learning is a quite popular topic. If you want to learn something more about machine learning on Quantpedia webpage, you can go to our blog and look for a tag machine learning and you will get all of the articles from the blog. Or alternatively, you can go to the screener and select the keyword machine learning, and then you will get all of the research papers and all the strategies that we have in our database. But of course, those strategies are behind the paywall. What do I have for you today? So we discussed internally in Quantpedia the most important thing, how to profit from machine learning strategies. And what we realized is that it's not how the machine learning strategy is built, how many features it has, what are the data. If you do all of these things right, so if you have a good data set, if you select the correct model, if you build your model right, etc., etc., I mean, at the end you will have the fine machine learning model. But the question is how to profit from that machine learning model. And what is the most important thing is the disagreement between the machine learning model and some other simple model. Why is that so? Even the other peoples in the market use the models to trade financial assets. And what is the most important thing is not whether your machine learning models makes a prediction that asset goes up or down, because also the models of the other people makes those predictions. What is the most important is the time when there is a disagreement between your machine learning model and the models of the other people, because then there can be a significant spread and you can make money out of that spread. So that disagreement between the machine learning models and other simple models is the most important. So we have an example in this article. In this example, we build a machine learning model for country ETFs. So we took 20 largest economies from 2008. We built visual representation of how they are spread geographically in the world. So here we have the US, here is the European economies, here are the Asian economies. Why we did so? Because there is theory that it's not just important how big your GDP is and what is your economic stance and how did you perform in the past, but also how you are geographically spread, because the countries influence each other, and the closer the countries are to each other, I mean, the bigger the influence. So we build a visual representation of the world economies. Then we use the past performance. This is the sample input data point. So on a weekly basis, we filled out our model with the data about the visual representation of the country and plus the past performance of the country. And we tried out to predict what will be the next week performance of each country on the map. So this is the list of the countries that we used, starting with the United States and ending with the emerging market countries. So in total there are 20 of them. We use the data from end of day historical data webpage to build, the weekly performance, and all the data are split and adjusted. Okay, and our hypothesis was that when we incorporate the geographic relationships between countries, we will improve the prediction of the equity price movement. So our prediction of the price movement will be better than just using the price alone if we, use also the geographical information and GDP information.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
So this is very simple, the machine learning model, but all of the machine learning models are based on this premise. So instead of using just one simple indicator, you use the mix of different inputs, and you hope or you believe that this mix of different inputs will give you the better prediction. So you will have the better prediction than just using price alone. Okay, so here are the results for the SPI prediction, and here are the results if you use just the simple price to moving average or trend following model. What we can see here is that the prediction from the machine learning model is very strongly correlated with the price to moving average ratio. So the correlation between what is the prediction of the simple model, the simplest one we could build, price versus moving average, is very similar to the prediction that we get from the machine learning. What is important, however, is not whether they are similar, but when there is a disagreement. So these are the moments. So when we have the prediction from the machine learning that is significantly different from the prediction from the price to moving average model, which is a very simple trend following model, this is the case when we should believe to the machine learning model, because if other peoples are using the more simpler or simpler models, they have their prediction wrong. So in this case, when there is a strong gap between those predictions, these are the best times when to bet using the machine learning model's prediction. The reason for that is because we believe that the machine learning, because it incorporates more information, would be more accurate. So how we tested it, we tried a long-short approach. In the long-short approach, if the prediction exceeds the price-to-moving average ratio, we took the long position in the corresponding country, and it falls below, we took the short position. And the size of each position was scaled by the absolute difference between the prediction and the price-to-moving average. So what does it mean is, if there was a very, very big gap, we bought the countries with the weight which was corresponding to the gap size. So I mean, if the gap was big, the position was big. If the gap was narrow, the position was narrow. So we have a benchmark performance. Benchmark performance is simply the equal weighted average of all the countries, and the green line is when we buy the country which has the biggest gap for the next week, and we short the country which has the biggest gap on the other side, and we weight the positions based on the size of the gap. So as we can see, the strategy, the green line significantly outperforms the benchmark positions. This is a top one model. It has the better performance, drawdown at the same size, higher Sharpe ratio, higher Kalmar ratio. So we can see that this long-short approach is better. Okay, then we have another approach, and it's rank model approach. So instead of weighting based on the gap size itself, we can just select top 1, top 2, or top 3 ETFs with the biggest gap, and we can spread the total portfolio size between the long and the short between the number of ETFs that we selected. So in this case, we are selecting top 1 or top 2 or top 3 ETFs. Once again, here you have a benchmark. This is the long-only strategy. So we are trying to beat the benchmark. We are trying to have the better performing portfolio. So once again, the benchmark performance is around 11%, and when we select the top 1 ETF, performance is nearly twice better. We have a little higher drawdown, but the Sharpe ratio is significantly better, Kalmar ratio is significantly better. We can see that the rank model also significantly outperforms. So what we can draw up as a conclusion, we can build simple machine learning model. We can incorporate geographic structure into the model's design. So in this case, we aim to capture cross-country peer effects, and which traditional indicators usually overlook, because they are not interested in how the countries are geographically spread, and they are just using simple trend following indicators. And our results show that there is a difference between the machine learning based and the naive predictors, and they can be used to build the strategies that outperform relevant benchmark portfolios. So we can really use machine learning, and the best way how to use the machine learning is when there is a disagreement. So there is a gap between what the machine learning model predicts and what some simple moving average or trend following model predicts. And the better machine learning model you have, the bigger gap and the better probability that you will gain some money from betting against the simple models. Okay, I hope that you like this idea. In case you like it, feel free to go to the article. It's in the description of the video. If you want to learn something about machine learning, I recommend you to visit also our blog, visit our screener. There are a lot of the machine learning strategies there, and I hope that you will join me in the next video. Thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.